Welcome to Opal TV. Today I'm in Zurich, Switzerland, together with Rudolf Bohli. He's the founder of RBR Capital. RBR Capital is an award-winning equity long-short hedge fund with a 10-year track record annualizing over 10%. Rudy, please give us a bit of your background. What did you do before you set up your company?
Prior to setting up RBR in 2003, I worked at a local boutique brokerage firm from 1997 to 2003, covering Swiss stocks selling to international global clients, including the hedge funds in London and New York. Prior to that, I worked at SBC Warburg in the Treasury Department, basically as a trainee from 95 to 97, and I have an electrical engineering degree from the ETH. Initially, our thought when we launched our first fund was that we want to differentiate with our competitors. They were covering the whole of Europe, and we said we want to focus on local alphas, right? Where is our local alpha? Our local alpha is in Switzerland and in Germany, where we speak the same language, we have very similar culture, and we have a very tight network. And I think that's something that worked very well with investors, and also worked very well with the returns up to the financial crisis. Then after Lehman, we kind of sensed, it's a new world. I think it's time to adapt. And I think we set out a plan what are the next stages going to be, and so there were multiple things which we changed. One is we realized the world is going to be a lot more regulated, right? So we started to lay out the plan to launch regulated products, including regulate ourselves as an asset manager here in Switzerland. And today we basically deal with multiple jurisdictions in multiple time zones, and with multiple products, right? So that was one leg. The second leg was on basically the investment universe. In 2009, we also said, okay, now is the time to expand our opportunity set and to do continental Europe ex-UK. Why ex-UK? Ex-UK because most of our competitors are London-based, and they have their local alpha in the UK, so there is no need for us to compete basically with Chelsea in the Chelsea Stadium, if I can use the analogy from football, right? The second thing, why did we think now it makes sense, right? Because the opportunities prior were a lot more correlated, I want to say, right? Banking stocks go up, all banking stocks go up prior to 2007. And now, post-Lehman, this has dramatically changed, right? In Northern Europe, you have a completely different economic backdrop versus the Southern Europe. And that creates the opportunity set we found very appealing.
So Rudi, please tell us more about your research process and how you run your strategy internally at RBR.
Our process is bottom-up, so we meet a lot of companies, right? So we say about 500 company meetings a year. I think the reality is nowadays it's actually substantially more than that, right? And that is basically how you gather a lot of information, right? By meeting the company managements and do the cross-reads, right? So that's what a lot of people also do, right? And then we boil it down to 30 positions. Once we have defined the investment case, we boil it down to 30 positions which we want to have on average in our long book. We start like with a 2% position. Why 2%? 2% allows you to basically to get more focus on your 800 names, right? If you have 800 names, you get lost. It's too much information, it's too much noise, right? So you have to boil it down. 30 names, and then that's where the real fun, where the real work starts. When you have a 2% position and the stock doubles, you you had too small of a position, right? It's great, but you kind of like are disappointed, right? Why did I only have a 2% position? If you have a 2% position and it drops 30%, you know, you're in trouble. You lost 60 basis points on a 2% position, right? That's not supposed to happen, right? So we create this focus in our core long portfolio with these 30 positions, and then you continue to do more research, and you want to increase the probability that you're going to get that right? And then I think people call it the Kelly rule, right? So if you have a higher, basically the probability you can assign to a position is going to define your position size. So as you go through your research process and you increase the confidence and the probability that you have a good pick, you can also increase your position size. And then, very important, leave the party early. You know, don't stay and have a last drink. Leave it early. Leave some of the upside for the others, so you have a clean exit and you can move on to the next idea. That's essentially what we do, and that's a process that keeps continuing, evolving. I think we have refined it over the years, but now I think the key thing is you need to keep the pipeline at all times full. You have 30 positions, you need to have a number of names that are going to be potential positions, right, where you're building on the investment case. And then once you have them in, right, is it time to increase or is it even time to sell? That's kind of like our thinking on how we build our long book. And that's also where we have the big part of the alpha engine, right? And I think that's no surprise as a long short. I have not heard yet myself about a long short that predominantly has the alpha engine on the short side, but we can talk about that maybe a bit later. Our universe has like 800 stocks, right? So there is a lot of noise, there is a lot of information, and we try to extract the relevant stuff, right? When we think we have a relevant information, you know, for a stock, we build an investment case, right? And the investment case basically has a price target, has kind of a time horizon, has like the scenario in there, what we believe how things will evolve and why we disagree with the current market price. Basically, we have, as stock pickers, we have two strong skills, right? One is basically the stock selection, right? So there, our betting average, on average, is in the low 60s. So kind of like if we pick 10 stocks, 6 stocks on average will outperform and 4 will underperform. So then once you have the betting average, you could argue, okay, you can do equal size, right? But we have a second skill that we can employ, and that is the skill of position sizing, right? So when do you size a position up? You size a position up when you have a higher conviction, i.e. a higher probability that you're going to get things right. And I think some people call that the Kelly rule. So the probability that you're going to get your investment case right on the single stock idea is kind of like defining the position size, right? So betting average in the low 60s, and then I would say a pretty good sizing skill by getting the higher conviction names right, and then at the end of the year, you know, ideally you get like your 5 winners that are going to be the big contributors of the fund return. That's kind of like our philosophy.
Rudolf, give us some details about your performance. Obviously, you have won a number of awards and you've been doing well, very well, in comparison to your peers. What's behind that?
Performance, obviously an exciting topic, right? It's probably one of the, in the end, risk-adjusted performance, the way you define it, right? There's many ways. So how do we look at it, right? If we look at our long book, That's where we have the big alpha and the big performance. So since inception, pre-fees, we have compounded our longs with roughly 20% plus on average over the last 11 years, right? So that's also what I always tell my analysts, right? It's like the hurdle rate for a stock to get into the portfolio is 20% for the next 12 months. Of course, I can accept a lower return if the risk is very low, and I will compensate that maybe with a higher risk position. So on average, you get your 20%, right? And then if you look at the short side of things, I think we also have considerable alpha on the short stocks. But if you look then at the actual returns, we basically break even on a 11-year history, right? Because on average, markets go up, right? You pay dividends, there is a cost to it. So you're swimming against the tide. And so by breaking even, I think that's already a pretty good result, even though I think that's obviously also for us going forward the focus and an ambition to even improve that.
So Rudolf, we talked a lot about your performance, about your style, about your strategy, but tell us, what's your true edge?
Matthias, thank you for this question. This is probably the central questions for hedge fund investing. And I think in every meeting I get asked this question in one way and the other. And here I must say I sympathize with the investors in hedge funds. It's a very difficult question to answer. That's why I will use a little analogy in the sports world, right? So let's look at Usain Bolt, right? 100-meter dash. What's his edge? He's the fastest, right? He's always gonna win the race unless he's injured or whatever, right? So if you're an investor, you're gonna put money on Usain Bolt, right? But when it comes to soccer or to golf or to something else, it's a lot more difficult to understand what the edge is. Now let me use as a Swiss citizen, and we are very proud of Roger Federer, probably the best tennis player in the history of tennis, as some say. What is his edge? It's obviously also there not a simple answer, but I think the most important thing is he is very passionate and he loves the game, and he always loves the game. So when he comes back on the court, every time you will see he likes it. He wants to win, right? So you have to be in the game to win it, right? And I think that's what we do as well. When we have a mistake, when we have a drawdown, we analyze it, we try to understand what happened, and we want to be back and we want to win, right? We're in this game to win it, right? Not to have the highest performance, but to have a very good performance with a commensurate amount of risk taken, right? So, and that's what we do, right? I think we are very passionate in this, and we continuously try to improve our processes. Many of the large US hedge funds, they use psychologists and these type of things. And let me tell you, we have gone down a similar yet slightly different path. And I think these are the type of things that allow you to keep an edge, right? So it's like, yes, you have to be passionate about it. You have to love it. But there's always going to be, there's always going to be times when it's not so good. And there, you have to change something, right? Or understand why did it go wrong, and maybe you have to change something.
Rudolf, give us an example of a time or of a situation where you have rearranged things at your company.
The biggest dilemma that we are basically faced with is always the same, right? It's greed and fear, right? And when you have a drawdown, the risk is that there is too much fear, and fear is always a bad advisor, right? So how do you deal with the fear, right? And I think what we started to do post 2011, the European debt crisis, we said, look, fear is not something that you can address on an intellectual basis, but you have to use a different tool, right? So we started to look into certain things that could work, and we found something that works exceptionally well. It's called neurofeedback. It's probably going a bit too far to explain that in detail, but what's interesting is basically mental training, right? But it's a very special technique used, I think, by many sportsmen. They use it for sure in golf. They use it in tennis. People do not talk about it. Why not? It's part of their secret sauce, right? It's their edge. So why should I give this trade secret away? But I think it's, you can Google it. There is a lot of stuff out there. I think it works pretty well, and I think that's something that brought us to the next level.
So Rudolf, you've been around for over 10 years now, and there were many ups and downs, obviously, in the markets during those years. But when it comes to your company and your fund, tell us more about your history, tell us more about the phases you went through yourself.
So we started in 2003, basically with roughly 5 million. That was my money, my mother's money. She put some of it into the fund, and my former boss also put in 1 million. For us, that was a great thing. We had some money to start, and we were very hopeful. You know, we're going to go out now and raise a lot of assets, right? So we go and we see our prime broker in London, and we give our presentation, and one of the cap intro guys in the meeting says, guys, great presentation, everything, but let's be realistic. There is no way you're going to raise any money right now. And that was kind of like the mindset, ooh, nobody has waited for RBR, you know, to come out of the gate and, you know, invest in our fund. So the first year was exciting yet tough. 2004, we were up north of 30% in a market that was broadly flat. So we were a very positive performance outlier, and so we got nominated by Hedge for best new fund launch of the year. Right. So that's 5 funds that got nominated. We didn't win ultimately, but for us that was a first great achievement. 2004 put us on the map, right? We raised a lot of money with the fund of funds in Geneva and in London predominantly. So we virtually went in a short period of time from being a small fund, single-digit million, to over $500 million, and we peaked at over 850 million in 2007, right? Then when the financial crisis hit, including Madoff, we also had some very high concentrations in our portfolio, which is a good thing on the way up, but not such a good thing on the way down, right? So the long shorts overall after Madoff basically they got all the redemptions, including us. So so we had a few things to struggle with, right? And Christmas, New Year, 2008, I think, was a defining moment. We already had a few $100 million of redemption served. We never gated anybody. We always said, look, if you gated, you know, you're never going to come back. Or that's just not our philosophy, right? It's like the guys gave us the money. That was the contract that we have, and we're going to honor this contract. So we served all the redemptions, and Christmas in 2008, I was somewhere at the beach trying to recover from the bruises, right? and I realized that we haven't hit bottom yet. So I came back in January and virtually sold our whole portfolio, and we actually had a very good first quarter 2009. And so we are up 4% in a market that's down close to 20%. I don't know whether you remember, but it was mid-March 2009 when, I mean, the levels that the stock market hit were obscene. The valuations and the fear that was out there was unbelievable. And I still remember that. I think it was Sarkozy and Merkel and everybody together. Everybody said, here is the line in the sand, right? And Merkel said things she actually couldn't even hold up, right? She promised that all the savings money in Germany would be fine, right? She couldn't hold that promise if push come to shove, but it brought the confidence back. So we realized that this is a turning point, and we started to invest in exciting opportunities at rock bottom prices. I hope we will not see so soon again, right? So for us, that was a big turning point. We had a great 2009. We're up 60% plus, right? And of course, we still had redemptions. At the same time, we basically wanted to reposition ourselves, right? So I think what I explained earlier, geographically, we expanded our scope. Then, like from a regulatory point of view, we started all these initiatives to get fully compliant and regulated. And the third thing was also the investor base, right? For us, it was clear that our investor base is not going to be tomorrow's investor base because they had all these issues, right? So today we have a much more diversified investor base, also the distribution network that we built up. So we don't want to get into this concentration again, in this concentration risk, right? We had concentration risk on the investment side, and we had a concentration risk on the investor side. And that was a bit too much to chew on, right? I think so that was a big defining moment in RBR. And the positive news was it gave me also the opportunity to rebuild the team, right? So on the way up, you know, it's very exciting, and everybody makes a lot of money, but on the way down, that's when you see who's got really the staying power, right? So a lot of the early partners left for one of the other reasons, and I must say I'm still in very friendly contact with actually all of them. But they left for one or the other reason, and that gave me the opportunity to build a new team. And I must say, I think today I have a very exciting team. I think everybody's going to talk about that they have an exciting team. But I think the team that we really have right now is definitely the best we ever had at RBR.
Rudolf, tell us about your risk management at RBR Capital.
Let's start actually with our portfolio, right? So we said we have roughly 30 names on the long book. We have 20 to 25 names on the short book. That's what we believe we can reasonably well manage with the current team, right? Given that the shorts are smaller on average than the longs, because a short is more risky than a long, right? If a short goes against you, the problem gets bigger. If a long goes against you, the problem gets smaller, right? So putting these things together, we will have a net long book on average from the underlying positions, right? So our single biggest risk is an external market correction. right? And I must say, currently the world we live in, this is a very realistic risk, right? Interest rates are at an all-time low. Debt to GDPs are at an all-time high. Central banks are accommodative as never before, right? So you have to do something about that risk, number one, right? So what do? We buy out of the money puts, and we finance that partially by selling out of the money calls. We do that on a short-term basis, so we roll it forward, right? And that gives us basically the insurance. If there is something externally that's going to happen, an external shock, we will be protected, right? To give you an example, in October, when the markets were down 10% intra-months, we were in our Cayman fund down a bit over 3%, and in our UCITS fund just about 1.5%, right? So that strategy, I think, works very well, right? So that's from a portfolio perspective. Then if you go into the individual names, it's like there it's research. You have to stay close to the company, right? So that is the risk management essentially. So it's ingrained in the investment process. And then of course you still have the risk manager who has a separate set of eyes, and he looks at the portfolio from a different angle. So he will look at concentration risks that we don't obviously see, right? Of course, we have sector limits that are 20%. We have small cap risks that are capped at 20%. That's normal, right? That everybody has. It allows you to have the flexibility. But then the risk manager will look at other risks, right? We'll say, okay, from a macro point of view, don't you think this could be risky or that, and these kind of things, right? And that has all to play together. But the key principles are you need to be very diversified, right? So that's why we have the 30 names on the long side, the 20 to 25 names on the short side, so that if something happens in the portfolio, you are not forced to take like big stop losses, right? But you can wait, you can assess, and then you can take the necessary steps. I do not like stop losses. We are fundamental, right? So stop loss is sometimes you have to do it, right? Because you got things wrong and you realize that you're in trouble, then you take a stop loss, right? But generally on the long side, we reassess things, right? Companies do profit warnings, stocks go down, right? Towards the year end, as we are now approaching, people are selling losing positions, which is a good thing in the short term, and which is a good thing for year end, right? Because you don't have to show it in your books. But it might be a horrible thing next year, because those could be the winners of next year. So we say we reassess the situation on the long side. On the short side, generally, if a position goes 30% against us, we cut 1/3, right? Why is that? Because it puts us back to square one, right? The position is again the same size like we initiated it on a higher level. Of course, we can still get things wrong, right? Then we will completely cut it, right? But if we think, hey, the case is actually valid, but our timing is off, it gives us a chance to stay in the game, right? That's a bit how we think about stop losses.
Rudolf, what's your growth strategy? Meaning, what type of products are you offering right now? Where do you see them growing? And what's your overall vision for RBR Capital?
Let's first talk about growth, right? So on the growth side, as far as products are concerned, currently we have a UCITS fund, right? So that's predominantly for European onshore investors. And currently we sell it in Switzerland, and we're planning on launching Germany predominantly, and I think that's about it. The Cayman fund, which we have, That is today for US-based investors. And there we also have for US onshore investors a Delaware LP, right? We also have seeded a long-only fund because our alpha predominantly comes from the long side, right? And so I think that's something that's pretty exciting also in the long-only world. If you can, somehow translate this 20% plus over the last 11 years into a long-only product, I think that's something that could sell. And down the road, I could see us launching more products that make sense within our equity competence, right? So we have, let's say, a core competence on Germany, Switzerland, right? So you could maybe see us launch something on the strategic value side, I want to say, in order not to use the word activist. I think it's a bit overused. So that's one idea, and then I think we have more ideas down the road. The other thing now, how do we go geographically, right? So we think you have to be in the US as a hedge fund investor, not only because it's the biggest market, but also you get a lot of intelligence out of it, right? So, I do two things as CEO and Chief Investment Officer of RBR, just two things, right? I talk to companies regarding potential investors, and I talk to investors. The benefit of talking to investors is that investors also talk to a lot of other hedge funds, and as a result, you also get a lot more information. So by talking to the companies and the investors, you get a lot more cross-reads. And you want to be in the US because that's still the market that moves Europe, right? Every time there is an issue, geopolitically or whatever you have, the marginal buyer and seller is the US. They will buy and sell European equities. So there is a lot of benefits by being in the US, right? And then I think we'll plan to add a few more countries there in the north and south where it makes sense, working with third-party distributors, right? Because you really want to be diversified on the investor side. I think that's key.